You may have seen ARK Invest's recent stock projection if you know Tesla and the financial markets. Tesla Incorporated shares are expected to more than quadruple to 4,600 by 2026, according to Cathie Wood's ARK Investment Management. ARK's updated model was released on April 14th, which is more than 4 times today's pricing. Last year, ARK predicted that Tesla's stock would achieve $3,000 by 2025. Still, it has subsequently revised its forecast due to its fresh assumptions about the company's potential robotaxi business and capital efficiency. What are these assumptions, and how exactly did ARK arrive at these new numbers? Keep watching to find out. While many people worldwide, including those in government, are opposed to Tesla's full self-driving capability, ARK is growing increasingly hopeful about it. As a result, Tesla's potential robotaxi company is included in the investment firm's newest future value. According to ARK, Tesla shares may be worth $4,600 by 2026. In a previous analysis, the business forecasted a share price of $3,000 by 2025. By 2026, the bull case predicts a price of roughly $5,800, while the bear case predicts a price of $2,900, which is still more than 3 times its present share price of $1,005. ARK estimates that Tesla will nearly triple in value even in the worst-case scenario by 2026. To this effect, ARK stated, "Although calibrated to our predictions for 2026, we believe our Tesla model is methodologically conservative. We assume Tesla's stock will trade like a miniature firm rather than a high-growth one in 2026." Analysts consider a variety of essential aspects when determining price targets. While some analysts factor in Tesla's full self-driving capability and prospective robotaxi business, many do not. This is most likely because the technology lacks features, despite CEO Elon Musk's repeated promises that it would be ready by the end of this year. Regardless of Musk's overly upbeat social media tweets, there are still a lot of unknowns regarding FSD Beta's progress and the possibility of Tesla starting a robotaxi. The potential of Tesla to construct and roll out a network of self-driving robotaxis is critical to ARK's bullish thesis on the firm. According to ARK's research, the network of taxis would provide an Uber-like service for transporting people to and from various locations. According to ARK's simulations, electric vehicles are expected to account for 57% of the company's income in 2026, though at lower margins than robotaxi revenue. This model's attributable revenue, earnings before interest, taxes, depreciation, amortization, and value are broken down by the business line below. The company's robotaxi operation, according to ARK Invest, will account for nearly 60% of the estimated value and more than half of the planned earnings before interest, taxes, depreciation, and amortization in 2026. At the Cyber Rodeo Festival to honor the inauguration of Giga Texas, Tesla CEO Elon Musk stated that such a service is in the works. Before we explain ARK's current price target, it's worth recalling that earlier iterations of ARK's prediction models sparked investor skepticism. Wood has been a longtime backer of Tesla and its CEO Elon Musk. Even though the flagship ARK Innovation ETF reduced its stake in Tesla last month, the electric vehicle maker remains the fund's top holding, accounting for 10% of its assets. In early 2018, ARK CEO Cathie Wood anticipated a price objective of $4,000, which is $800 after a 5-to-1 split before the enormous stock price increase and the pre-split run-up. The Tesla stock price is currently around $5,000 pre-split price or $1,000 post-split price in mid-April 2022. In early 2018, many individuals couldn't believe the price. In early November, Tesla stock achieved an all-time intraday high of $1,243.49. The stock has been under pressure since the beginning of the year, owing to macroeconomic concerns and component shortages and input cost inflation caused by the Ukraine-Russia war. The stock managed to recover through March and early April after bottoming out late February. Tesla's stock fell nearly 3% on Friday after Musk announced his bid for Twitter. Shares finished at $985. A $1,000 investment in Tesla shares at Friday's closing price would have yielded 1.02 Tesla shares. By 2026, if the stock is kept for the following 4 years and reaches ARK Invest's price goal, it will be worth $4,692. This equates to a 369.2% return on investment. When looking at ARK's research, it's important to keep in mind that they used a statistical model to generate a variety of situations. Assumptions concerning critical business variables such as the number of automobiles sold, the average selling price of those cars, and so on are used as input for those scenarios, and the result is the probabilities of various situations based on assumptions. The most important point to remember is that this strategy is nearly entirely predicated on Tesla's vehicle business and robotaxi prospect. However, a few items are not included in the model. For one, Tesla's AI as a service, robot that looks like a human, and the company's renewable energy business. From ARK's perspective, it seems logical not to include those business components in 2026 because they all involve a level of uncertainty, which would result in excessive volatility in the model. Tesla, for example, has prioritized its automotive business in recent years, and this may continue in the future. This is primarily owing to the battery's availability and scalability restrictions. Furthermore, the solar industry relies on third-party installers, making scalability much more difficult. According to Elon Musk, Tesla's software, including its AI training systems, is open to licensing as a service, but no potential partnerships have been announced yet. The timescale for the humanoid robot is likewise difficult to forecast. Tesla has struggled in the past to develop its vision-based AI for full self-driving. When iterating different models, they've always seemed to reach a ceiling at some point. The vision-based AI that Tesla is currently developing for its cars will be the heavy lift for the humanoid robot. So without AI vision, there will be no robot. ARK Invest still maintains that Tesla stock still has a lot of room to grow. According to ARK's bull case scenario, that network could generate $486 billion in annual income for Tesla by 2026. ARK estimates that Tesla's robotaxi network will generate $51 billion in yearly income in the worst-case scenario. In addition, Tesla produced about $54 billion in revenue in 2021, mainly from the sale of electric vehicles. The great question for investors is when Tesla will be able to commercialize completely autonomous vehicles, let alone network of self-driving taxis that can travel between villages, cities, and countries. In ARK's worst-case scenario, a self-driving taxi network will be operational by 2026. The ARK Investment Management Company stated, "Not only have the commercial releases of Waymo and Cruise bolstered our present outlook, but so have fundamental improvements in AI. According to the midpoint of our calculations, Tesla will begin commercializing autonomous ride-hailing in 2024. Given ARK's positive outlook for Tesla shares, it's no wonder that the electric car firm is the investment manager's top holding across all of its ETFs. According to data from Koifin, ARK owns $1.43 billion in Tesla stock, making it the only stock in ARK's flagship ETF with a positive performance over the last year. What are other analysts' standpoints? According to Morgan Stanley analyst Adam Jonas, Tesla is a renewable energy onshore infrastructure company, not just a car company. According to the expert, Tesla stock is cheap from this standpoint. However, following a 40% gain in the last year, not everyone is as optimistic about the stock. According to David Traynor, CEO of investment analysis firm New Constructs, Tesla stock might plummet as low as $150 to $200. For a brief time, Tesla had fast mover advantage, but that is no longer the case, and there are plenty of other electric vehicles on the road that are competing extremely successfully. According to Traynor, Cathie Wood is just throwing out words that may be appealing or interesting to unsuspecting retail investors, shiny, glittery things, when they're missing the point of where Tesla is competitively positioned. Skepticism aside, Wood's model suggests exorbitant profits. According to Tasha Keeney, an ARK analyst, a key factor is an expectation that Tesla will be more capital efficient. As a result, Tesla's capital expenditure per incremental unit of capacity has decreased to $7,700 from $84,000 in 2017. Meanwhile, while Tesla's Bitcoin holdings are included in ARK's model, they're not seen as a critical projection component, raising the price target by less than 5%, according to Keeney. Instead, Tesla might pursue other commercial prospects not incorporated in the model, including energy storage, artificial intelligence as a service, and a humanoid robot. ARK has made its model open source, allowing anyone to tweak the parameters and run simulations. What do you think? Do you agree with ARK Invest's forecasts? Comment down below.